As gold continues to see downward pressure, our next guest says he's closely eyeing the gold-silver ratio. Joining me today is Mike McGlone of ETF Securities. Mike, thanks so much for being with us.
Thanks for having me.
So it was a hard day for gold and silver on Tuesday, gold taking a 2% hit, silver 7%. Now, Mike, I know these two metals tend to follow each other's lead. So is silver dragging gold down?
Yes, well, it is. It's not the only thing dragging gold down. The deflationary trend has resumed. Look at crude oil. It just plunged from 60. It's broken down out of the range. Iron ore is broken down. Copper's broken down. Palladium, platinum. Silver's just one of that game. The key thing is gold's actually been one of the best performers. I mean, it's the store of value, the diversifier asset. So it's being dragged down in the deflationary environment. And deflation sometimes can be good for gold only to the extent that it involves economic discombobulation, Fed easing, and the Fed's not easing yet.
Right. So I know you're closely eyeing the gold-silver ratio. It's around 72, near its peak of 80, 84 back in 2008. Is this cause for concern if we're looking at global GDP?
Absolutely. As you can see the chart on the screen, it's overlaid, it's global GDP overlaid with the gold-silver ratio and the inverse. And then it's been elevated above above 72 for the longest period since 2003-4, even longer than 2008. And it just broke out to a new high at 77. It's just showing you what we've discussed earlier. Gold is showing a similar relation to almost any other commodity. And it's showing you that the potential, this store of value has value, but almost all the other commodities with industrial relationship, which silver is, are showing the opposite. And it's really precarious for global GDP. I mean, look what's happened in China lately. Auto sales are getting hammered. We've seen what's happening in the equity market. And I view it as a very significant indicator because sometimes it's leading, and it apparently is leading in a negative way right now. Hopefully it won't, it'll top out and silver will do better, but right now it's showing a bit of a negative situation for global GDP.
Right, and you'll closely be watching what the Fed says this week in a minute?
Yeah, and the Fed's not going to say much different. If you watch their last two meetings, the key statement is the Fed will be likely to raise rates when the labor market meets their expectations, continues to improve, and inflation is, they're reasonably confident inflation will meet their 2% target. We're nowhere near that year there. They expect that to happen. We're not near there yet.
All right, let's take a closer look at gold now. Continues to disappoint. Investors are asking, what do we do at these levels? Is it time to get in or to jump ship here?
Well, this is one of the things I think you learn in the pit really early. Sometimes the hardest positions are the ones that make you hold on and make you really question yourself at first. So I think gold is a place you're supposed to be overweighting. 2-3 years ago, you were supposed to underweight. And look at it this way. If gold breaks down or doesn't go up from here, a year from now, say because the economy is doing better and the inflation, there's demand pull inflation from wages and the Fed's tightening, amen, that would be wonderful. But that's an unlikely scenario, and I think that's why prudent investors need to be reallocating and making sure they're diversifying their portfolios. And gold and bonds have been doing well, are somewhat attractive at current levels if this current situation in the global economy, certainly if it stays the same or actually continues to go in the trend, which is a bit precarious.
Right. Well, CFTC report recently said that pessimism near all-time highs in the metals. Does that concern you?
Oh, sure, it's great. It's bad in the short term, but if you're looking to be a contrarian, which I am, you look at open interest in silver, all-time new highs, and platinum, all-time new highs. That's an indication of new shorts because the market's been going down. And that's generally what will drive a bottom in the market. They'll be reluctant to continue lower, but can drive a sharp spike. That's usually the kind of indications you get when markets are at extremes.
Mike McGlone, thanks so much for joining us.
Thanks for having me.
And thank you for watching. We'll see you tomorrow for a brand new Gold Report.